And now, please enjoy the panel discussion. Ladies and gentlemen, welcome to this further session of the ICISA Surety Week 2022. This is the Emerging Markets panel, and it's a panel I'm really looking forward to because we're covering new territory. Now, it's my pleasure to introduce the moderator of this panel, Adrian Kerle. And Adrian has been in this industry for an extremely long time. He's been in the insurance industry since 1988, although he was only born in 1970. He had a long and distinguished career at Swiss Re, where he started in credit and surety in 1992, and eventually retired in 2019 after leading the effort since effectively 2005. Since then, he's enjoying life, and he is doing work as a consultant and advisor to the credit insurance industry with various non-executive mandates. He's also currently president of the Pan American Surety Association, PASA. So, Adrian, if I can ask you, take it away.
Thank you very much, Richard, for this nice introduction, for making me younger than I am. And hello to everybody, and welcome to this interesting panel. It's a pleasure to me to chair it and to discuss this such an interesting topic like surety in emerging markets. The aim of the panel will be to discuss advantages, but also challenges of surety that surety faces in non-developed markets. It's a pleasure for me that I will be joined today by three distinguished gentlemen who are all well-known professionals with a very long track record and experience in the financial industry. And let me start by introducing them to you. First, a warm welcome to Johnny Simmons, who is most probably well known to most of you. Johnny has been involved in the surety industry for more than 18 years. He previously was the CEO of Lombard Guarantee in South Africa, which is the largest company in this country. Today, he is the chairman of a company called Insurety, an alliance of businesses operating in Africa, out of Lombard, South Africa, in Europe, out of Nordic Guarantee in Sweden, and in Australia, out of Asset Insure. I'm sure that we will hear a lot of interesting comments from Johnny on how he and his companies have been developing surety not only in South Africa, but also in other markets of the African continent. Further, I'm especially pleased to introduce Vikash Khandelwal to you. Vikash is an entrepreneur with a history of building business from scratch in a complex market like India. He has been involved in the surety business for the last 5 years, and he has been instrumental in the introduction of surety guarantees in India. Currently, he is the CEO of ICISA, which is the first surety company in the country. Previously, he has been a financial services professional all throughout his career, having built diverse businesses for large corporate groups. I'm very curious to hear from Vikash on how he has been managing the challenging of introducing surety in India, and what he will tell us about the potential this line of business has in your country. And last but not least, I'm happy to welcome Thomas Kessler. I'm sure many of you still know Thomas, as he was working for around 18 years in the credit and surety industry, servicing markets in Europe, Africa, Americas, and Africa. I had the chance to work with him for many years at a small reinsurance company in Switzerland, and I was always impressed by his broad knowledge of the business and other cultures. In particular, of course, Asia, where he lived for more than 15 years in locations like Tokyo, Hong Kong, Hanoi, and Singapore. Since 4 years, he works as principal finance and disaster insurance specialist at ADB, I could spell it, at the Asian Development Bank in Manila. Thomas will certainly give us an interesting view of the Asian markets from a slightly different perspective. He has a long-standing experience in surety, where he has served the Asian market. He knows it still very well. But of course, in his job at ADB, he got new insights. And of course, his scope is much broader than it has been before. It would be very interesting to hear his comments. But before I give the word to my colleagues, I would like to make a few general comments on the topic on surety business in emerging markets. Looking at what we would typically call emerging markets, we face a pretty heterogeneous picture around the globe. There are emerging markets where surety has been nicely developing for years and even decades, like, for example, South Africa or certain Latin American countries, and others where surety is still in infant shoes or does not exist at all. We will certainly hear more from Johnny on the challenges that they are facing in South Africa, but let me make a few comments on Latin America, where I have observed the development of the surety markets for many, many years. We're all members of ICISA, and most of us stem from European and North American markets where the political economic situation is rather stable over the years, and where people start to shiver when inflation goes up to 5% already. Building up and developing surety in emerging markets comprises many difficulties and challenges that we typically would not face in developed markets. Latin American surety companies, for instance, deal not only with volatile economic and political instability, but also with legal uncertainty, weak local currencies, corruption, inefficiencies of the ministries in the bidding process, or when it comes to release the bond at the end of a project. They also often struggle to get reliable financial information from the contractor. And some countries also have difficulties to attract foreign and private financing for the large and important projects because of the weak and volatile macroeconomic situation that very often results in a very low country rating. Particularly difficult is the situation in countries like Venezuela, where it becomes more and more difficult to run this line of business, as also international reinsurers are hesitant to allocate capacity in the market. Nevertheless, and despite all these challenges and difficulties, surety has become a very good alternative to bank products and is an important economic factor for certain industries like the construction one. And it has shown a nice growth over time, and leading market in the Latin American regions like Brazil and Mexico nowadays produce almost 500 million of US dollar premium a year. And as many of you know, most companies have been able to even deliver good results despite all the mentioned issues and problems. Then my short introduction about the topic, and particularly about Latin America. And now let me ask Johnny Simmons about his experience in South Africa and other African markets he does business with. So Johnny, please tell us more about how you developed surety in South Africa. What are the highlights? What are the challenges you're facing? And then also, of course, also in which countries your companies are doing business in Southern Africa, and what are the challenges and opportunities there? So Johnny, the floor is yours. Thank you very much.
Thanks, Adrian, and thanks very much to ICISA for putting together this very interesting week. I'm very honored to be part of it, and I think it's a very interesting topic that we are discussing. Listening to you talk about Latin America made me think that we were talking about Africa, because I think a lot of the points that you've made, Adrian, are common to our experience. But maybe a little bit about our company. Lombard Insurance Company has been around since 1990, and we are a South African-based company, but from pretty early on in our existence, we started doing business in countries that were bordering on South Africa, primarily Botswana and Namibia. And more recently, in the last sort of 10 or 15 years, we've gone much further afield and have done business in much of sub-Saharan Africa. It's very difficult to describe Latin America, I would say, as Latin America. The countries are unique within them, as is the case in Africa. It's not possible to think about it as a homogeneous market. It is the countries are as diverse as they could be. But to give you some sense of the scale of our operation, and here I'm going to focus primarily on contract surety. We do other guarantees, but the numbers that I'm going to give you here are really in respect of construction or construction-related surety. So the peak exposure we've had in South Africa was about $2.6 billion. And the peak exposure in countries outside of South Africa, in Africa, is $550 million US dollars. The countries that we currently have exposure in, just to give you some sense of what those are, we have 100 or so million exposure in Kenya, about 70 million exposure in Mozambique, 70 odd million in Lesotho, 30 million in Zambia, and 28 to 30 million in Uganda. But we have had exposure in Nigeria, we've had exposure in Algeria, we've had, not Algeria, in Angola, and we've had exposure in Ghana before. And it's important to understand that although South Africa is one of the most developed countries in Africa, it's still very much an emerging market. And although surety is well developed here, I wouldn't like you to think that this is a first world market that exists in South Africa. It's very, very much so. So it's an emerging market. So all the business that the Lombard Insurance Company does, I would say, is in emerging markets. I wish I could say that this has been an entirely happy experience for us, but it hasn't been. In fact, we have paid a disproportionate amount of claims in the business that we have done in Africa, and we've really paid some very expensive school fees, some of which we've recovered from and some of which we remain exposed to. We paid a claim of about $130 million in Ghana, and we have some large exposure in Kenya right now, which is under claim, and we are busy trying to see where, it's involved in an administration and a court process, which we'll see what the outcome of that is. But let me just give you some sense of some of the challenges that we have faced in Africa and in South Africa, and you'll see whether there's some common ground amongst all of us on this. Political instability mentioned by Adrian, but certainly a very significant factor. We've seen it in our own country as presidents change. We've had a high level of corruption, and political instability creates difficulty in the economy and uncertainty with regard to projects. We've seen that within provinces in Kenya. There's differences in the political regime between the two provinces, and if this province's regime is in power, then the other province suffers. So you might get a change in attitude to a project that happens within a country just because there's a political change. So you really have to understand that stable politics is not something you're going to encounter typically if you're doing business in Africa. Often the judicial systems are dysfunctional and unreliable, and wherever possible, we would try and make sure that if there is any adjudication, that this takes place outside of the native country or the home country. Often regulators would require local participation from insurance companies within those countries. And whilst, I think that's welcome because it will help develop the industry there, it often does create problems with payment, collection of payment if one is partnering with those companies. Often the paper that is issued is not of a great quality, and so whilst there are obvious benefits, there are some drawbacks in having the regulations enforce you to have local paper as part of your the offering. Often the funding of projects is a problem. It does help if you get funding from somewhere like the EU or from large external banks, which often do provide the funding. That does create some difficulties as well, particularly if the conditions where the contractors are working are difficult, because others have very low tolerance for delays, and often you face the spectre of calls which are on guarantees which often you would regard as bordering on unfair, simply because there are delays, and once again, working in some of these territories is quite difficult. There's a lack of understanding of surety in these markets. Often the products are provided by banks, and so breaking into these markets is difficult. Markets are not that big, and so getting to scale is very difficult. And certainly our experience here in Lombard, where we were doing business throughout Africa, was that our business was a mile wide and an inch deep. So you end up spreading yourself very, very thin. And there are administrative issues. Geographical distances are large. Often travel is difficult. There's lack of proximity. Premium collection and forex issues are, I think, Adrian, you mentioned that sometimes these countries run out of foreign currency and are unable to pay. And often, surprisingly, even in developing countries, bureaucracies are very, very high. And so you find yourself having to deal with bureaucracies or bureaucratic institutions, which are very difficult to negotiate your way around. So I suppose distilling all of that into 3 or 4 points, if I could think about things that we might do a little bit differently if we were to do it again, would be to build country by country, not spread yourself too thin. Try and get build a business that in a country that offers a good economy, a good judicial system, and an ability to build a comfortable market size and market penetration. Get legal and finance people involved right up front. Establish clear administrative processes that are understood by all. And if you are working with partners in countries, create a mutual understanding of expectations that everyone understands. That's it from me, Adrian. I hope I've stuck to my time. I think I have. And I would welcome any questions from the floor or from anyone else, should you have them. Thank you very much. We can't hear you, Adrian.
You're on mute.
Okay, now we can hear. Sorry about that technical issue. No, thanks, Johnny. That was very interesting. I think your comments really go to the point, and obviously we note that you have a lot of experience. Thanks also for the recommendations at the very end for other companies who want to actually go into the region. Before we come to questions, I would like to move to the second panelist, which is Vikash Kandalari, India, and that it's a topic, of course, that we especially like to discuss today because it's really kind of breaking news, good news. I think we can now do surety business in India, which is fantastic, you know, and those who know a bit the market know it needs probably quite some time until you get there where we are. And of course, who could better tell us about this success story and then Vikash, with us about the difficulty we're facing along the way until it actually could say, now I can actually go with a company, ICISA Surety, and start to produce surety in the market. Please, Vikash, curious to know.
Yeah, thank you, Adrian. It's a great pleasure being part of the first ever Surety Week. India is probably the youngest country in the global surety map. We started this year with the insurance regulator announcing the surety insurance guidelines. And this was promptly followed by a finance minister actually announcing changes in the general finance rules to accept surety bonds as an accepted security for public procurement contracts. And this was announced on the 1st of February in the annual budget, actually. So I'd like to start with giving you a brief glimpse of the Indian surety landscape. So India has traditionally been a bank guarantee market, right? So banks cater to 100% of the guarantee requirements, which entails cutting across banking limits, locking up collaterals, margin monies, etc. You know? And so we've got the infrastructure sector, which is struggling a bit. They started with huge debts, currently experiencing a severe liquidity crunch. So India as a country, we've also had a problem with project delays and cost overruns as well, right? So just to give you a sense of the kind of project delays and the cost overruns, we've got a ministry called the Ministry of Statistics and Program Implementation. Now, this ministry actually monitors projects which are large infrastructure projects of national importance. Currently, they're monitoring about 1,670 odd projects. Almost 438 of these infrastructure projects, which are monitored by this ministry, are running experiencing a cost overrun of almost about $57 billion. 563 of these projects are delayed, and some of these projects are actually delayed beyond even 10 to 15 years. And these are especially the ones which are in rural electrification and irrigation. So these are very large projects. I mean, by this, the central government, and they're beyond the timeline by almost about 10 to 15 years. So the Indian commercial banks, the ones who are using the issuing the bank guarantees, are also experiencing high levels of NPAs. Now, NPAs are non-performing assets. So they are now reluctant or unwilling to even issue guarantees to the infrastructure sector. Now, having said that, so that's the current situation. The opportunity in India is huge. It's actually humongous. So there are almost about $152 billion worth of bank guarantees, which has been issued only to the infrastructure sector. Over and above that, we've got central government, which has continued its thrust onto infrastructure. And this is visible in the sharp increase in allocations for highways, rural roads, housing, transports, and the works. Last year, the government also actually announced a $1.3 trillion worth of investments in the Gati Shakti Master Plan, which is for multimodal connectivity. So this includes 25,000 kilometers of roads and links through 5 different rivers. So these are the 5 different large rivers of the country. And to add to this, we've got the various state governments which cumulatively invest close to about 75 to 80 billion dollars every year in sprucing up their own infrastructure at the state level. The opportunity is not restricted to just to infrastructure projects. Now, the insurance guidelines, which was announced earlier on in this year, also allows the insurer to issue custom bonds and court bonds. Now, if you were to move away from the infrastructure part, we've got the micro and the small and the medium enterprises segment now. There are almost about 63 million entities which are part of this MSME segment that we've got in India. This segment has a debt or a deficit of access to formal finance, which is almost to the extent of $750 billion. Right? So if you had a surety which is comfortable with moving out of the normal way of actually underwriting the credibility of an entity and look at alternate data, it can make a huge impact in the MSME segment. And these are good quality enterprises that we're talking about. The rental bond market has a potential of almost about 4 to 5.
Vikash, you muted yourself.
Sorry. So from an underwriting perspective, and this is quite contrary to the popular perception that people have, there's a lot of good quality data available for surety underwriters to be able to assess the capability of contractors. We've got a well-evolved credit information system, and this is run through credit bureaus that we have. We've got 4 credit bureaus. And this has the data for all financial data for all the contractors as well as the promoters, and includes the level of indebtedness also for the contractors as well as the promoters. Further, the guidelines which have been issued by the insurance regulator allows insurers to be able to access as well as share data with banks as well as the contract awarding bodies. And this data could be with respect to cash flows, the performance of the company in terms of the track record of execution of projects, invocation of bank guarantees in the past. So that entire data is actually available, and which would enable a surety underwriter to be able to underwrite effectively. The challenge today, I mean, if we were to look at India, is the dearth of surety-related expertise, right? I mean, and it's a completely new concept, and it's at its nascent stages. So we really don't have availability of surety-related expertise. Now, what's going to happen is most of the insurers were planning to start writing surety lines of business this year would probably look towards their reinsurance partners, and tap into their expertise of writing in sureties globally. And this is why most of the reinsurers would look at the Indian partners to be able to get a good understanding of the local landscape. So I see a void here, which might delay or actually deter people from starting off the writing of surety lines of business. As such, on the brighter side, India can be a very good opportunity for surety professionals globally. What I see making a difference is, again, because of the lack of knowledge that people have in India of the concept of sureties and the benefits that it brings along in terms of assurances of projects, liquidity, etc. We need to actually start off with a good awareness drive within the country on the benefits of surety. And I think it would be nice if we see the insurance industry as well as the government who can partner together in creating this kind of awareness. I'd also like to see the setting up of specialist surety companies in India, which can actually focus on developing these lines and ensure that there is capacity creation, there is creation of expertise, and actually can take the lead in developing and taking advantage of the opportunity that's opened up. Because there is a sizable opportunity which is begging to be taken. The biggest tailwind that we've got, the strongest tailwind that we've got, is the government's active support. So the government is extremely keen that the surety lines as a business actually develops well in India. And this is something I see as a big advantage for all surety companies looking at coming in, operating out of India. So as such, the stage is actually set for the surety industry in India. And I guess we're truly emerging. Thank you.
Okay, thank you, Vikash, for this excellent comments, and I learned a lot about your market within this 10 minutes roughly. It was really exciting, and I certainly will have a few questions, of course, to learn more about that. But before we do that, I would like to welcome our third panelist, which is Thomas Kessler. Thomas, as we mentioned before, has a lot of experience in surety business in Asia, everywhere in the world. But Thomas has also experience of other lines of business, has experience also working now with Asian Development Bank, and can look at the markets from a slightly different perspective and maybe give us his view, Thomas, about the Asian landscape or South Asian markets, how you see that and how you see the future there. Please, Thomas.
Well, thank you very much, Adrian. And yes, it is indeed a great pleasure to be here again after some 10 years since my last active interaction with so many of you. And therefore, clearly, I need to say I'm no longer a surety expert, but I'm even more flattered to have been invited to this panel. So, let me simply stick to what I feel comfortable with and outline what I've been doing in the past year since I moved from the credit and surety steadily onwards to public sector market development. And hopefully this will provide you with some complementary perspective of how to overcome some of the challenges in developing surety business in an emerging market, and how institutions like the Asian Development Bank could support this process with you. Basically, since I joined the Asian Development Bank, I've been trying to bridge the gap between the public and the private sector, promoting the value proposition of insurance and looking for some solutions to enhance our bank's financing services to our developing member countries. But for those who maybe are not so familiar with the Asian Development Bank and multilateral development banks, let me quickly outline who we are and what our mandate is. So ADB was founded in 1966. We are a multilateral development bank. We have 68 member countries, and the headquarters is based in Manila. We do have 40 field offices. They are all placed in our developing member countries who are eligible to our support by means of we provide them loans, sovereign, but also private sector, equity investments, lots of technical assistance to support the development, and also different types of guarantees, first loss protection, and risk sharing agreements. We are some 3,500 employees spanning over 64 nationalities. And our multilateral development bank peers, they are, for example, the African Development Bank, the Inter-American Development Bank, European Investment Bank, the Asia Infrastructure and Investment Bank, and of course on a global scale, the World Bank, and you may be familiar more with them. So our vision, and we are focusing really on Asia and the Pacific, is to achieve prosperity, inclusivity, resilience, and sustainability. And important is to sustain all our efforts to eradicate extreme poverty in Asia. You may be aware that still around 40% of the world extreme poor are located in Asia and the Pacific. And of course, the pandemic has worsened that situation. Also, important factor that an estimated 1.7 trillion US dollars per year is needed in order to achieve the 2030 infrastructure gap targets. And also an important factor is that 10 of our countries are most exposed to climate change and disaster risk. So out of the 7 globally most exposed, 7 are our developing member countries. And so this has led our strategy 2030 to be fully aligned with the 17th United Nations Sustainable Development Goals. So our operational priorities, they include continuously eradicate poverty and narrow inequalities, and gender equality is thereby of high priority. And I know you have a panel also been addressed on that specifically this week. Most important is to tackle climate change. We have announced in Glasgow at COP26 to extend our commitment in cumulative climate investments by 2030 to $100 billion US. Now, we want also to help our cities to become more livable, as urbanization is another dominant topic and trend across our region. Rural development and food security is equally important. And another important priority is to strengthen governments and institutions, talking about legal and regulatory environments to enable sustainable development, and also deepening regional integration and cooperation to tackle issues at a regional level, and for instance also to strengthen cross-border. The top agenda is the post-pandemic economic recovery, as well as more sustainable infrastructure finance and increased climate finance to achieve the objectives of the Paris Agreement and the Sustainable Development Goals. So the challenges are immense, and it's clearly an urgency that comes up. So the recognition that we need to establish public and private partnership in order to catalyze private sector financial resources for the development is here, and that's one of our main focus. And that is really also where the insurance and particularly the surety comes in. This development trend provides huge opportunities for the surety insurance, but traditional approaches perhaps need to be slightly adjusted. We may not be as impactful if we are just trying to develop insurance and surety markets and sell insurance products on a standalone basis. Rather, we need to try to sell our value proposition, adding it to large project finance, making them more sustainable. And I would like to give you some concrete examples in order to illustrate this. So first, I would like to mention the Pacific Regional Infrastructure Facility. It's called PRIF. Members of multilateral development banks, donors, Pacific Island countries, and other stakeholders are part of this facility. And we are helping governments in the Pacific Islands to enhance their capacity in infrastructure planning. And we are helping them to develop a priority national infrastructure project pipeline, leading them to corresponding investments. Just to give you a sense, the yearly project pipeline so far on average is about $1.5 billion US, mainly in sectors such as energy, to focus on renewable energy, transport, water, and urban sector development. And of course, we are aiming at even larger figures. But one of the challenge here is the construction cost in the Pacifics they are quite high, and there are different factors. So, for instance, the geographic remoteness of the islands. There is a lack of in-country resources and knowledge, and some of the projects are perhaps a little bit smaller scale. So these factors and of course the impact of climate change have made it very difficult to find competitive construction as well as insurance markets. And now currently what we are discussing is the proposal to set up an insurance facility for PRIF and its project portfolio, which then will allow to involve insurers' expertise, for instance, in risk management services, in a very early stage of these projects. It will offer a comprehensive insurance program to cover risks throughout the life cycles of the project, from the construction phase to the operation phase and the maintenance phase. And of course, the whole range of construction performance and maintenance surety bonds can be applied and would be of great value here. So the second example I wanted to highlight is the way to make use of innovative instruments from the insurance industry, and specifically the surety industry, to more effectively ensure small and medium enterprises to access finance. So as you know, SME play a crucial role in the sustainable development. They represent 70% of employment and 90% of the total enterprises in developing countries across all sectors. And they have been hardest hit by the pandemic, but they also leave a huge environmental footprint. So this can be turned positively in investments, in allowing them to make investments in green technology. And that is what is aimed in a project by ADB, which is the Green Investment Finance Project of Kazakhstan, where ADB is providing funding to financial intermediaries such as eligible national and commercial banks. And they provide loans specifically to SMEs for innovative energy efficient green technology investments. And now we are talking with Energy Base. This is a Swiss non-for-profit foundation, on adding to the loans so-called energy saving insurance. And energy saving insurance is structured as a surety project. It is providing SME with a third-party guarantee against the risk of technology provider failing to fulfill its contractual obligation regarding specific energy saving targets. So to summarize, there is currently huge opportunities in emerging markets to offer surety value proposition, attaching it to substantial funding made available for investment to recover from the pandemics, but also to reach the Paris Agreement objective and the UN Sustainable Development Goals. Perhaps the traditional way to develop the local market step by step, which is still necessary, but can be kind of leapfrogged to make the industry more recognized and the product offerings, but also this may need somehow to adjust and promote green and sustainable projects by adjusting the project and the surety bond offerings and products. Yeah. So yeah, let me stop here. I'm happy to take questions and perhaps to get the chance to elaborate a little bit more how surety markets and ICISA can work together with multilateral development banks. But at this stage, back to you.
Okay, Thomas, thanks a lot for this very, very interesting views, and also looking at the market and the area from a different angle and perspective. And the world is a small one, it's all interlinked, and I'm Of course, I didn't hear the word surety that many times, but indirectly, yes. You were talking, for example, about insurance facility, that you want to intend to set up. That my question would be, would it include guaranteed? Would it include potential surety bonds? Or you as ADB, would you typically accept in a big project you're financing only bank instruments, or would be a surety bond an option to actually guarantee such big projects?
Absolutely. I think that's really the key and the message, right? So the idea is to involve the insurance sector early in the phase of a project in order to recognize the risk and to perhaps design them much better. And so the full range of surety construction products, can be offered and would be integrated. So and that could, it would actually. That's why I say leapfrog some development, because you don't need to establish or to develop a market-specific regulatory framework, but you could attach it to the investment triggered by the multilateral development banks, and so actually provide your services immediately. Yeah, absolutely.
Mm-hmm. Okay, thank you very much, Thomas. Very interesting, and let's use the time maybe also to put the questions to the other two participants. Maybe for Johnny, I think you already gave the recommendation how to be, or what you would do differently when you next time go to Botswana and to Angola and all these countries. You mentioned also that you had a claim, or there will be claims when doing business. How are you gonna go in a recovery stage? I can imagine that in certain countries it's not that easy to recover a loss, because some of the legal base may not be there. There is the theoretical uncertainty and the like. So maybe in a nutshell, have you made kind of experience, or can you give kind of recommendation how to tackle that?
So I think the first thing that we would wherever possible try and do would be to have any conflict resolution hearing held outside of the country in which we are, if wherever possible, maybe in a neutral destination like London or Geneva or somewhere like that, where you felt as though or the international court of conciliation, whatever, one of those places where you could have access to something that that you felt wouldn't be subject to some political interference, shall we put it that way. Now that's not always possible, but that's one thing that we would try and do. The other thing, I guess, would be to look very carefully at who's going to call the guarantee. Is it a capricious government institution? Is it going to be driven by the funders? So to try and understand what the calling regime will be, and obviously make sure that you're comfortable with that. And then I guess what saved us in the case in Ghana was that the risk that we were writing, in other words, the construction firm that was doing the work, was a South African-based construction firm, and of course we could then we were in our own country in trying to deal with that claim. But that is it is a critical part of this, Adrian, is to try and understand what's going to happen if things go wrong, and where will you have the fight, and who you're going to be fighting with. It is very, very difficult. It's very, very difficult to operate in many territories where, as I say, the judicial systems are unstable. Very, very important part. I don't have any answers necessarily. This is what worked for us, but it is a very important thing that you need to understand. And as surety gets developed in India, for example, you're going to people that write this business are going to find out that these the laws as regards insolvencies and liquidations, and those are going to become very, very keen for you to understand them. You're going to get to understand them very well. I hope that helps.
No, you definitely learn by experiences, by actually being in the market, and that's why you said before as well. It's good to do one market after the other as well, And I'm talking about India, and I'm coming to Vikash. I think very interesting what you told about how you developed. And I was actually quite nicely surprised when you said the government would like to foster surety bond and likes surety bond. That's already a good advantage, because I think in other markets you first have to make public surety, you have to make known surety, and that's what they typically see in other emerging markets, that you come with this product and it's not known to the market, and sometimes brokers can help, to spread it. How would you do that in India, like the distribution of this product? Are there brokers who know about surety, or agent, or how is the situation there?
So Adrian, we've got a well-evolved broking system, right? So when the regulator came out with the guidelines, it said that the general insurance companies in India could write surety insurance business. So they've defined it as a surety insurance class of business. And that includes contract sureties, that includes custom bonds, and that includes court bonds. Since it has been classified as an insurance class of business, all the insurance brokers, we've got both, on the direct side as well as on the composite side. A composite broker can do reinsurance as well as direct insurance. The broking fraternity would be able to sell these bonds.
Okay.
There's one more point I'd like to add out here. The demand side is never going to be a problem in India. So, and I'll just add to this by saying that if you are a middle or a small level small sized contractor in India, and if you go to a bank for a bank guarantee, you'd probably have to put up more than 100% collateral in the form of real estate. Right?
Good.
Over and above that, a small contractor would have to put in margin money, which is in the form of cash with the bank, almost in the range of that could anything be between 10% to 35%. So it sucks out a significant amount of liquidity from the contractor itself, and it also hampers his ability to execute the project. Right? So demand is never going to be a problem. I think it's the supply side which we've got to address in the country. Right? We've got to have adequate number of players getting out there and be willing to ride this business.
Perfect. Now, I think the sheer numbers that we heard before are really impressive, and I hope that if only a small part materializes and actually turns into premium for the surety companies of this world, that would be great. Johnny, you want to say something?
I just want to make an observation on what you were saying with regard to the banks maybe not having the capacity to be able to service the market, and to kind of correlate it with what we experienced in South Africa in the run up to the 2010 Football World Cup was exactly that. And in fact, that was the period in which contract surety really established itself in our country, is in that period where we were able to, with the support of reinsurance capacity, really grow our presence and the presence of other sureties in the market. So this is a wonderful time for you to build a business, I would say, in India.
And Vikash could comment, Johnny and Vikash, organizations, associations like the ICISA and American Surety Association are also there for that, that you can exchange experiences, like with Johnny, for example, and who can help you actually to successfully develop the product even more in the market. Thomas, you want to say something, but then we have to,
Yeah, I think, this requires actually a dialogue, right, with the government and the regulator specifically, right, to understand, the impact and more efficient way the financial sector as a whole is working. And I think that's where also, the dialogue together with multilateral development banks can be helpful. We have a relationship with the governments which are perhaps a little bit more neutral, because the government, appreciates the dynamism of the private sector, but is also always a little bit, afraid on how much it engages. And we do have, overall program we are supporting, and especially, this financial sector development, is a topic we are having, and we can bring in these elements, and that can help you in your argumentation and bringing up, the value proposition more clearly and neutrally, perhaps from a third-party position of an important stakeholders with the governments.
Perfect. Okay, I think we could probably discuss for another hour or so, because the topic is very interesting and a lot of questions will pop up, but I think we have to respect the time a bit. I think it was, for me, a very, very interesting panel that we had here. I learned a lot, and we see that exciting new market in India, where we all hope that it will grow the way Vikash expects. Johnny is further conquering Southern Africa, which is great, and Thomas will promote surety within ADB, so that's all promising. And I thank you very much, gentlemen, for your very, very valuable contribution. And I will now hand back to Richard, because I think audience may have some questions to you guys. Thank you very much.
Thank you so much. I think that was interesting, and I think you thought it was interesting, because if I see the amount of questions asked on the chat and the very good questions mentioned on the chat, with your permission, we might go over a couple of minutes, because I think there's some really important ones in there. Apologies for the beep. We tried to work on it. We couldn't get it done. I hope you will forgive us for this. In the meantime, could I ask Vikash and Johnny to turn their cameras and their mics on, please? And there they are, live. Gentlemen, welcome live. A lot of questions, like I said, and unsurprisingly, a lot of questions for Vikash on India, but also a number for Johnny. And Vikash, if I can start with you. There was a discussion about capacity. You said demand is never going to be a problem in India, but supply might be. Johnny said, yep, reinsurance is probably vital. And from previous discussions, I know that you are very interested in reinsurers, and reinsurers are interested in you, because one of our reinsurance members asked the following questions. Are bank statistics in the surety product available for the Indian market in terms of things like premium, loss ratio, and a product type split? Would you be able to answer that, Vikash?
Richard, if I get you correctly, you were asking about the bank loss ratios, loss experience. Yeah. See, banks in India have a problem on multiple ends. So it's just not about the bank guarantees. I mean, banks in India are by and large experiencing severe NPA problem. So they've been corporates who borrowed and are unable to pay back. Having said that, I think most of our contract awarding bodies in India are fairly considerate, and they give adequate opportunity to the contractor to remedy the default before they actually go in for invocation of the guarantee. So as such, I mean, if I were to quote a senior member of NHAI, which is the National Highway Authority of India, I mean, the invocation rates in India are in single digits. So they're fairly low in India. As policy, most of these contract awarding bodies do not get into invocation of the guarantees unless they're really compelled to.
Thank you. That should give a lot of confidence. Now, I've got one for Johnny, because this is emerging markets in general. Is there a preference for public beneficiaries over private ones, and if so, why?
So, I mean, realistically, even if you, I mean, I would say in general, we would prefer to have public beneficiaries, because the calling regime is generally fairer. I mean, obviously politics dependent, but that's would generally be our preference. And also, I would say it's probably is our experience in South Africa, although we have quite a big private, we issued quite a lot of guarantees in private entities, but in Africa generally it's been to public entities that we've issued. Realistically, most of those entities are funded by, in some way, externally. So you need to understand that aspect too. But I would say in our experience, most of it is to public funders and our public state entities, and that would generally be our preference. And as I said, it's probably because the risk calling regime is a bit more responsible.
Thank you.
I hope that helps.
It does indeed. Now, Vikash, I've got a difficult one for you. There have been a number of related questions, and they're all on recoveries, legal proceedings, and indemnity agreements, where I think just about everyone has noted that in the IRDA guidelines of the 3rd of January, the word indemnity agreement was not noted. Now, could you talk about this, please? And could you tell us how you plan to run recovery proceedings?
Yes. So that's been one of our concerns, Richard, and the guidelines that were issued has not made any reference to the rights which are granted to a surety company. Now, in India, a contract of guarantee is governed by the Indian Contract Act, and which grants the surety or a guarantee company the right of subrogation. Right. So essentially, what happens is that it steps into the shoes of the contract awarding body. Now, that part of it is fairly simple till then. What complicates matter is, we've got other regulations like the Insolvency and the Bankruptcy Code, and we've got the SURFACI, which governs borrowers from banks and bank borrowers. The IBC, which is the Insolvency and the Bankruptcy Code, makes a distinguishes between financial creditors and operational creditors, and the differences also translate into the kind of rights that each category of creditors actually are granted under the IBC. There's not sufficient clarity in the IBC whether a surety company would it rank as a financial creditor or an operational creditor, because the rights are going to be impacted, and this would include even the waterfall mechanism should the company actually get into an insolvency kind of a scenario or an administration kind of a scenario. The other concern is also on contract enforcements, but I guess, I mean, that's currently work in progress. The government is working hard at improving contract enforcement in the country. So we are particularly happy about the progress on that front, but this is something that we'll probably have to address as we go along.
Now, if I ask Vikash a tough question, I have to ask one to John as well. Right? And the question here is, how does the political situation in a country impact on pricing of surety bonds, with particular reference to the invasion of Ukraine over the past couple of days?
Yeah, I mean, look, I saw that question and I kind of hoped it wasn't going to come to me. You don't really have much defense in the price that you have charged in a situation like that, I would guess. I suppose I think the question is also how will the surety respond, and I guess you'd have to look at the underlying contract to see how the contract responds to a situation of war or an invasion or whatever. And I suppose the ancillary or the guarantee contract to that would respond in the same way. Depending, I think it really depends on the wording. It's very, very difficult. I mentioned political instability is something that has caused us a great deal of difficulty in the past. I just don't. In another one of our businesses that we have a business that operates in Finland, and they've done a lot of business in Russia itself, and that presented some problems with them around calling. I just think you're very, very exposed to situations like that, and it cannot be comfortable for surety providers or banks in a circumstance like that. You kind of just hope that by some fortune you don't find yourselves there when that happens. I don't have an answer. I think what you will find is that it'll be very, very difficult for those entities, if there are such entities in the Ukraine at the moment, as we have found in areas where there has been political instability, where we have issued guarantees. Very, very difficult.
Yeah, I've kind of feared you were going to say this. And having mentioned Ukraine from the side of ICISA, our deepest sympathies for anyone impacted in the invasion. Maybe one last question, because it is 2 past the hour. And this goes in the direction of conditionality. And it's a question of for both of you. How does conditionality impact your business? And additionally to Vikash, is India, in your view, going to have conditional or on-demand guarantees?
You want me to go first?
That'd be good.
All right. India is has traditionally been a bank guarantee market, right? So most of the contract awarding bodies are kind of used to an unconditional and on-call document. So my sense is, I mean, we're possibly about to start surety guarantees around the 1st of April. So we still got about a month there. But there's no clarity as yet whether this is going to be an on-call or an unconditional guarantee or a conditional guarantee. But my sense is we are going to start with an unconditional guarantee. So, I mean, if the guarantee is invoked, no conditions, it has to be paid. I think that's where we will go. I think it will take some time for India to evolve into a conditional guarantee market, and wherein even in the contract owners would be comfortable, accepting a conditional document.
Thank you, Johnny. What's your experience in this regard?
I would say our experience is that it's very hard to be in the market and not move towards stronger wordings. I think the market is there, but there is no question that it adds very significantly to the risk. And in our experience, people call or beneficiaries call those guarantees because they can, and because they can, they often do. Puts money in their pocket, and then the whole negotiating stance is on their side, because you and your client are trying to get it back. So there's no question. It makes it's a very important consideration. Try and stay away from it as much as you can, Vikash. But my sense is that it tends towards stronger wordings because that's what the market's used to.
This morning, very early Central European time, there was an e-summit by the Association of Chambers of Commerce and Industry in India. A client took the podium and said, "We want wordings like we've had before, and we want them cheap." It's going to be a very interesting meeting. With that, Johnny, Vikash, and at a distance, Thomas and Adrian, thank you so much for an interesting panel. Like I said, lots of questions, and that's a good indication. Only one session left in the ICISA Surety Week 2022. 2 p.m. CET. We shall have 3 amazing ladies in the surety business. I can recommend the session to you, and I hope to see you again at 2 CET. Thank you so much.
Thank you.
And it is 3 CET, of course.